Okay, we are very fortunate to have Paul Herman with us today. Paul is the CEO, founder, and chief investment officer of HIP Investor. He is a globally recognized leader in investing to pursue positive impact and profit, and is the author and co-editor of two books, The Global Handbook of Impact Investing and The HIP Investor. Both are available in the San Francisco Public Library collection, and they're used in teaching sustainable finance around the world. Thank you so much for joining us today, Paul. I'm going to stop sharing my screen and turn it over to you.
Great. Thank you, Jonathan, and welcome everybody. Appreciate everyone being together. And through the power of online video, we can all have a conversation at the same time. So I'm Paul Herman. I have lived in San Francisco for 30 years until the middle of COVID. And so most of my work is done online and on video. But I do visit investors and our clients all across the country and outside the country as well. Thank you in advance for joining. We're going to cover ways today to have your portfolio take climate action. So I'm going to share the screen right here. And again, these slides will be available afterwards. If you do have a question, feel free to put this in the Q&A box, and either Jonathan will address it or I will address it as we get there. HIP stands for Human Impact and Profit. But of course, for us to be humans, we need a place to live. So this visual here on the screen, which was almost the cover of the Global Handbook of Impact Investing, but several people said it was too scary. The reason why we show this first is we want to choose what to live in the environment on the right: green grass, blue skies, clean water. And we want to avoid the environment on the left of scorched earth and methane-filled clouds. So that's what we're going to talk about today, is how to help move all of us towards the right, including in your portfolio or in your employer's 401k. And then happy to answer any questions today on the webinar or afterwards. Just so all the lawyers and regulatory people are happy, I'm an investment advisor, registered in the United States and several states and serving clients across the country. I'm also the founder of a second company that you're going to see a lot of data today, data and ratings. And so we rate investments, more than 400,000 investments with our team at HIP Investor. Remember that none of this is an offer of securities, and all investing has risks. And the past is not indicative of the future, especially in climate. This is our 19th year at HIP Investor. HIP stands for Human Impact and Profit. And in addition to rating 400,000 plus investments, we manage portfolios of funds, mutual funds, and ETFs. And I can see somebody's already asked about mutual funds and ETFs, and strategies of stocks, like a science-based target for climate action strategy or a great place to work strategy, or one of our successful strategies this year, global dividends, which is up more than 28% so far this year. And as Jonathan introduced these two books, the HIP Investor on the left, this is the 15-year anniversary. We should give a shout out to Leah Hillman, who retired last year at San Francisco Public Library. I'm here today because one of our first book events was on the Potrero Hill, San Francisco Public Library 15 years ago, before I jumped on a flight to Switzerland for another event. And it's actually not only in the San Francisco Library, it's in more than 200 libraries around the world. In addition, the book on the right from 2021, that's now the 4-year anniversary. And inside that book, there's a whole section, multiple chapters on fossil fuel-free investing, on green transition bonds, on climate impact bonds, as well as other environmental, social, and human characteristics. Okay, and then probably in the library, I'm sure the Bill Gates book on how to avoid a climate disaster is in the library. That's a super resource to get up to speed on what some environmental solutions are and the power of Bill Gates's brain of that will solve this part of the climate disaster that is a risk. Jeanine Firpo, who's also based in the San Francisco area, has written a book called Activate Your Money, very tangible solutions in that book. This one from the Wharton School Press, Making Money Moral. Morals are important more than ever, including in our portfolios. Alex Edmonds has one about growing the pie and human capital. And of course, Donut Economics. These are all super helpful reads if you want to take action in your portfolio. Okay, so everybody's climate means it's your climate, it's my climate, it's like Oprah, everybody's climate. So we're going to talk about ways to take action in your portfolio on stocks and bonds and on funds and on your employer's 401k. In addition, some of you are living in cities and counties with climate action plans. Those cities and counties need funding for their climate action plans. And so most of the climate action work that needs to get done, especially now in an environment where federal money may not be flowing as much or at all, these are places where in your own city, in your own county, in your own region, in your own water district, they're open to investors that aren't just taxes, fees, and muni bonds. So we'll touch on that before we finish up. All right, this is the cherry blossoms of Japan in Kyoto. And one of the interesting things is they mark the date every year that the cherry blossoms reveal themselves. And what has been documented now from about the year 800 through the 1100s, 1400s, 1700s, and today is that date is moving earlier each year. And so spring is arriving sooner than expected for hundreds of years of observations. So this comes from Nat Bullard, who has a multi-hundred-page PowerPoint, which if you're interested in more statistics about climate, highly recommend it. And we put a link in here, so when you get this PDF, you can click and read more. So the climate is changing. So what can we do about it? We can do at least 4 things about it, 4 big strategies for all of us today. We can invest your portfolio or your IRA or Roth IRA or SEP IRA to optimize taxes. You can allocate your money in your employer's 401k. And in some of those cases, usually in larger companies, if they don't have choices that you agree with, if you're working for Salesforce or for other large companies, they have something called an open window or self-directed investing. Might be on Fidelity or it might be on another platform. So if you're not happy with your 401k choices at your employer, you can potentially go find some of the ones that we're going to talk about. A third way to get engaged is whenever possible, vote your shares of stock, especially now that that may be under threat in the current administration, who are now saying that you need to own 1% of the company. So that means Nvidia, which is almost 4 trillion, you would need to own $40 billion of stock. Under current law, you only need to own $3,000 of stock to file a proxy, and everybody can vote their shares anytime there's an election. That is under threat in today's US administration. And then, most importantly, engage on a person-to-person level through email. Any investment company has somebody in charge of investor relations. Many of them watch their social media. If you ever have a customer problem, I like to go find the person in charge of that business unit and access them through LinkedIn or through email. And if they care about the customer, they'll engage with you. If you care about climate action and you own companies in your portfolio, or if you own mutual funds and ETFs in your portfolio, engage the fund managers, engage investor relations. It's speaking up so that this can become an issue because unfortunately, in some places, they'll ask the investor relations person if anybody's asking about topics, and they're like, oh, no, we don't hear anything about it. So unless we speak up in politics, with our investments, at work, how we purchase, that's super important. Okay, so we'll just take a pause here because there's already 3 questions. John asks how to get international ESG, environmental social governance, mutual funds or ETFs. One way of going about this is in the US, there are funds that invest overseas. One of the companies based in the Bay Area is called Matthews Asia. There's another one called Parnassus. There's another one called Impacts. So there are fund products, mutual fund products, ETF products, including democracy investments. Democracy investments allocates on an index basis around the world, allocating more to companies based in democracies and allocating less or not at all to those that are authoritarian. So we'll touch on a couple of those shortly. Second question, do you have thoughts on investing in local businesses via small business bonds? Love to hear more about this. Investing in small businesses can be compelling. You have to know your risk profile. So know, are you prepared for this business to not pay your money back? Or are you prepared for your business to take longer than expected to pay your money back? One of the ways to do this is through credit unions, through sustainable banks. There's a new climate bank called Climate First Bank based in Florida, but operating nationally. Some of you may remember New Resource Bank, which is now Amalgamated Bank. They were acquired a few years back. So loaning money to businesses, especially entrepreneurs who are women and people of color, are super effective ways to support your community, but that also need to have a business hat on to evaluate that risk. There's one other type of institution. The shorthand name is CDFIs, Community Development Financial Institutions, CDFIs. And there's a business called MyCnote, MyCnote, that loans money to CDFIs from investor dollars that come in at MyCnote. That's also written, Bay Area company with two women co-founders who are awesome, Kat and Julia. All right, third question. How toxic is cryptocurrency mining? Well, I don't know how toxic it is, but I do know that it's very energy intensive. So cryptocurrency is a monetary instrument of which there's debate as to whether it's a store of value or an investment or both. The current administration has positioned the SEC to say crypto can proliferate more. Crypto is based on the blockchain. The blockchain is a very solid architecture that allows tracking data. Think of it like a bank vault for data, except you're using money. In order to produce the security, it takes a lot of energy power. And so that it's very energy intensive to produce. Some of that energy may be fossil energy, and therefore it might be toxic in the environmental sense, which means methane emissions and things like that. So ETFs. So yeah, sorry, let's back up a second. ETFs are exchange traded funds, and they're in the similar category of mutual funds. So mutual funds and exchange traded funds are a basket. So think about if you go to the supermarket or the farmer's market, in that basket is 30, 50, 100, 500 stocks or bonds. And so instead of buying 30 companies individually, you buy a basket, a fund, and that fund can be a mutual fund from Schwab, from Fidelity, from Vanguard, but also from companies like Parnassus, local companies like NIA, NIA, and or democracy investments. And so those funds, ETFs or mutual funds, allow you to hold a diversified mix. All right. Vanguard funds that have a positive impact from Gretchen. Okay, Gretchen. This is very difficult to answer. Vanguard has recently pulled out of the Net Zero Alliance, meaning to be less engaged in environmental action. Part of that is driven by the state of Texas. The state of Texas has a list called the boycotters of fossil fuels. There are some Bay Area companies on that list, like Etho Capital, which has a fund that invests in climate positive companies. Etho treats it as a badge of honor that they're on this list. And what that list means for the state of Texas, which is now there's about 200 plus companies on that list, is that they cannot get any allocations from the state of Texas pensions. Vanguard saw that and said, "Oh no, we're out. We want your money, state of Texas and related entities." So Vanguard does have a something based on something called the FTSE Social Index, FTSE Social Index. FTSE is Financial Times. Index. And that is an index that negatively screens out companies and invests in the rest. There's a small handful of Vanguard branded funds that do that. But if you have a Vanguard portal, you can buy more than Vanguard funds, which we'll talk about some choices you might explore. All right, another question. How do we reconcile? By the way, this is like the thing these days on YouTube. You have a bunch of questions, so I'm channeling that energy, and hopefully that feels very interactive to everybody. NE asks, how do we reconcile the need for investments to grow to meet investor needs, like your retirement goals, education, healthcare, indefinitely, yet stay within our equitable finite resources and ecological limits, like donut economics, Kate's book? Great question. This is the challenge we have all the time. And the number one challenge is fighting the concept that it's possible. So it is possible, and I'm going to switch from climate to people to explain this. When you invest in companies that are great places to work, the Great Place to Work is another Bay Area company that measures the employee satisfaction of the people in that company. To fight the concept, like Alex Edmonds, previously a Wharton Business School professor, my alma mater, now at London Business School, that if you pay people more, they can be more productive. And so it turns out that when you invest in great places to work and you pay people a fair wage or even a higher than fair wage, that's not added cost if the people are more productive. And so it turns out to be the case now for going on 2 decades. And we have a great place to work investment strategy at HIP that investors allocate to. Is that strategy is averaging about 14% returns over a dozen year time period. So markets are up, markets are down. The high one year was 40%. It was down 20% one year. But on average, over a dozen years, it's been 14% returns. And the reason why that exists is diverse teams innovate more. Happy employees don't quit. The dollar store, which we all may be familiar of, dollar store has is offers some great deals for its customers, but nobody likes to work at the dollar store. In fact, the employee turnover of the dollar store is 400%. That means the average employee quits every 3 months. So you can't run a business like that. And that's why the dollar store has been having financial problems. So to answer your question, how do we stay within finite ecological limits? We innovate. We become more efficient. We use renewable energy technology. We invest in great places to work. And those things have a positive return on investment. So it is possible to have a sustainable return, not necessarily an extractive return, but a sustainable return, and live within our limits. But we have to do this for the whole world of 8 billion people. So there's a lot of work to do. Okay, IMS. I'd be interested if you know of any funds in Fidelity. Fidelity is interesting. There's two, again, like Vanguard, two answers to this question. What is branded a Fidelity fund? And what is buyable on the Fidelity platform? So branded as a Fidelity fund, there are several sustainable funds that Fidelity uh, puts a positive effort into to have a mix of stocks and equities in a sustainable equity fund. That's one choice you can find on Fidelity if you look up Fidelity Sustainable Equity, I believe. They also do it for bonds. But if you're saying, if I go to fidelity.com and I have my 401k there or I have my personal portfolio there, can I find mutual funds, ETFs, stocks that are sustainable and climate action? Yes. So we're going to talk about some of those in our time together. And then Timothy's comments. It can be tough finding Vanguard funds that have a positive impact. So yeah, we're going to talk about, there's a website, nonprofit website called Fossil Free Funds at fossilfreefunds.org. And that's a great tool to give you a monthly perspective on how much exposure there is. Okay, so keep the questions coming. I love the Q&A being engaging. So these are all ways for you to engage. So one of our stories today is about Kristen Magnuson. When I met her, she was Kristen Magnuson. Today, she's Kristen Magnuson Hershowitz. She works at a company called Stoke. So that's a San Francisco-based company that operates nationally and now internationally. And she's an architect in sustainable architecture, lead architecture. And she came back from a Bioneers conference about back in 2015 and said, how come our 401k isn't sustainable? How come my own portfolio isn't sustainable? So that's why you're here today live or watching on recorded. So let's find out how Kristen can help solve her issue. So one of the things we do at HIP is we are data driven. So like you, curiosity of why you're here today is what can I do for the climate? So the good news is more than 14,000 companies have stocks on different exchanges, US, Canada, Brazil, South Africa, Japan, Korea, and they produce some type of information about their greenhouse gas emissions, their water usage, their energy usage, and their waste or recycling. So, for example, PepsiCo, which makes half of its revenue is food, half of its revenue is beverages, they recycle a lot inside Pepsi. They report that upwards of 90% of their materials are recycled in some way from the waste streams that come out. Um, so, out of these 14,000, how do you pick where to invest? So the way that we look at the world is the stock market price that you see every day is based on the future cash flows. And those future cash flows don't always map exactly to the accounting statements. One, because they're in the future. But two, because things like people are recorded as costs on the income statement, not the value they provide. In addition, from back in the 1970s when we had a lot of manufacturing in the US, the S&P 500 used to have a lot of tangible value on the accounting statements, and today it's mostly intangible value. Some of that is overseas manufacturing, some of that is intellectual property. So what we do at HIP in order to build these portfolios is evaluate those 14,000 companies for what that intangible value is. What is the knowable yet ignored quantitative reason for looking at companies? And relating to climate, that includes oil usage, energy usage, greenhouse gas emissions, waste. We also look at factors like diversity and legal exposure, as well as employee satisfaction. So in the jungle, they have the big four, the lion, the giraffe, the elephant, the rhino. Here, the big four for climate and how companies perform are energy, water, waste, and pollution, greenhouse gases. So what we do at HIP is we turn that into a score, a 0 to 100 score. And if you remember the image at the beginning of our webinar, the scorched earth is closer to a 0. The blue skies, green grass, clean water is closer to 100. It's very difficult to get 100. You would have to be a perfect, renewable, sustainable, regenerative company. There are no public equities like that today. However, there are good companies. So these that you see in the green, these approximately 1,200 companies out of the 14,000, are companies that are doing better, doing more positive than negative. Every company is a mix, but these are doing more positive than negative. And most companies are doing more negative than positive. They may have a good product, but it's produced in a wasteful way. So when you take this, which we've been doing for almost 2 decades now, and you say to the question that was asked, can you get a financial return from companies that are more positive than negative? The answer is yes for the 5 years ending 2017. The answer is yes. Whoops. The answer is yes for the mid-year 2020, first couple months into COVID, when the stock market dipped. The companies that were had higher employer satisfaction, that were more environmentally efficient, that were more diverse, on average, had better performance than the ones that did not. By the end of 2020, as stock market recovered, they also had strong performance. By the end of 2021, they had even stronger performance compared to their peers. So sustainably operated companies do this. Now let's look at 2022, same thing. 2023, same thing. So looking at how companies treat climate, nature, environmental ratios, humans, employee engagement, fair pay, not overpaying your CEO, having a diverse board, not getting sued. These are all fundamental ways of, if you explain to your parents how you're going to run your business, that's how you'd explain it to your parents. And so at the end of 2024, 6 months ago, still strong performance. You can see a little bit of crossover here. But this methodology that we've been applying for almost 20 years is a way to do good and make money at the same time, on average, over time. Okay, so let's talk about climate and climate action. And I think I lost the Q&A box too. But so let's talk about climate and climate action. See the chat, and just want to make sure there's no Q&A that I'm missing. Okay. Are there any portals or websites that do fractionalized investing in private impact companies or funds through crowdsourcing or something similar? Okay, so there are probably the not this takes a little more focus to dig into, so I don't have a fast answer to this. There are small slivers of groups of private companies where you can invest. There is something called impact assets, which is produces a list every year of the 50 private equity or private credit funds like SJF, Sustainable Jobs Fund, for example. Those generally aren't fractionalized investing. Those are, minimum anywhere from maybe 10,000, but usually 25,000, 50,000, 100,000 for one unit of a private fund or private company. So typically more for high net worth investors. But I will think about that and get back to you, Anoop. So please send me a LinkedIn. Okay, and then Sky asks, are there any AI developers that focus on sustainability and reducing environmental impact? I did that exact search right before this webinar to see, and there are. So if you just put in your question into search, or if you want to Claude or ChatGPT, there should be some that pop up. I at least trust the Google results. I haven't done the AI results. And there's anywhere from no less than half a dozen to a dozen companies. There's also something called Crunchbase that TechCrunch produces. And Crunchbase has filters for climate tech companies. So you can see that. Okay, and then Eric asks, thank you for having invested in one of our funds previously. Do you anticipate continuing with public offered ETFs? The challenge of any fund, especially a new fund, is having enough assets in it. So Eric's asking about a fund that almost had a 4-year track record, the VanEck HIP Sustainable Muni ETF. And, one of the questions you'll always ask as an investor is, what is the expense ratio? So it needs to have a competitive expense ratio. Like when you go to Costco, you want to make sure you're getting a good price, but you also want to make sure you're getting a good return. But in order to do that, like Costco, you need enough people to come through and buy the Costco card and shop. And to start a new fund, it is sometimes difficult to, well, it's frequently difficult to get enough assets in it. So we will continue on the strategies for individual investors that we operate on Schwab and Altruist and Goldman Sachs. Um, what's our next entrance into a fund in the future? To be determined. But thank you for asking about it, and thanks for being curious about it. Okay, so the US today, we'll say generously, is a third, a third, a third. A third progressives, a third conservatives, and a third independent. And those independents in the middle will sometimes swing towards progressive or sometimes swing towards conservative. In the last election, they swung more conservative. Climate affects everybody. And so, one of the ways I've found that has been successful to communicate what is the challenge that we're facing is to take the temperature about what is the upper limit of climate, translate that into first from Celsius to Fahrenheit for anyone living in the US, and then to translate that to human body temperature. And that starts to get some understanding of, hey, we need to do something. So if we think that the long-term average of the Earth's body temperature is similar to ours at 98.6, and now we're definitely on the verge of breaking through 1.5 Celsius, which is almost 3 Fahrenheit, which would mean 101 personal body temperature, um, you are sick. You have a fever. You might go to work, but you probably want to stay home. We're headed towards 2 degrees Celsius pretty fast. That's almost 4 degrees Fahrenheit. Now you're up to 102. You're definitely sick. You're in bed. If there's not enough climate action happening before the end of the century, 2100, we're definitely going to hit 4 to 6 degrees Celsius. That's 7 to 10 degrees Fahrenheit. You either have a disease that will kill you or you're already dead. So we need climate action. So this type of translation of temperature, Celsius to Fahrenheit to human body temperature, helps communicate. Nini asks, where are we now between 2 and 4? We are under 2 of the delta, about 2 degrees Celsius, above the delta of the multi-hundred-year average, but it is rising and it is picking up speed. So there was some recent data over the weekend showing how the curve. So another scientist, Zeke Hausfather, he is writing increasingly frequent op-eds for the New York Times. So there's a chart showing that increase is the rate of increase is increasing. Okay, and then Mira wants to suggest to Sky that she knows of the change.ai, and that may be something that fits your question. Okay, so what are corporates doing about it? So there's something called sciencebasedtargets.org. That is the Science Based Targets Initiative. And at sciencebasedtargets.org, there are more than 700 companies today that there are more than 2,000 that have either said science is important, or there's more than 1,000 organizations, governments, airports, that have said, we have a target. 726 of those are public equities, many of which you can invest in, some of which are overseas. And the most aggressive goals are these 4 companies at the top right: Unilever, Hannon Armstrong and real estate, NASDAQ, the financial company, and Novo Nordisk, which attacks diabetes and is an Ozempic drug. They are saying that they're going to reduce their greenhouse gas pollution 100% by 2030, at least through carbon credits, if not through efficiency and reduction. And then you see a mix of Ford, General Motors, Johnson & Johnson, SAP, Hewlett-Packard. So these are the ones with goals. Now remember, we said there were 14,000 companies reporting something. This is only 700. So it is a small percent of all companies. One of the things we do at HIP is we focus on the ones who are making progress. So here are some examples of leaders in science-based targets that we allocate to because they're tradable in the US. And And what is happening today, and this is one of the frameworks we have, is we split those 750 companies into three categories. Companies who have a target and who are ahead. So the ones in green, there's 340 companies where their target is they're going to eliminate greenhouse gases at a rate by which they'd be eliminated in 25 years. So at this 4% rate. They're ahead by double on average. So that's great. We need more of those. We need more of these 340 companies reducing 4% a year. There's a slice in the middle. And so that's companies who have a slightly even more aggressive target, 5%, so about 20 years to 100%. They're behind by half. So they're still reducing. That's good, but they're at half their annual goal. And then we have these companies with a goal, but they are going the opposite. Some of these companies are in tech, some are in AI. They're eating up more energy for the data. Some of them are industrial. You can see a company, ServiceNow, which also overpays its CEO by a lot. And so these companies need to get called out. It's great that they have a science-based target, but we would be skeptical about investing in them due to this climate exposure. Or if we do, we'd invest less than we otherwise would. Okay, so that's the global view, and here's the US view. The numbers are similar, so the leaders are ahead by more than double. The reducers are, but not exceeding their target, are behind by about half. And then this whole group on the bottom, including Apple and Qualcomm and Lululemon, and even First Solar, that have a target and are going the opposite way. So they're not becoming more efficient. So it's really, this is how we scrutinize who's real in climate. Another way we scrutinize who's real is by looking at where the greenhouse gas emissions are coming from. So the good news is there are increasing set of tools, including Al Gore has a multi-organization conglomerate that's tracking greenhouse gas emissions real time. This is reported greenhouse gases from big facilities. Big facilities are 25,000 tons a year or more, so only 2,000 tons a month. That's sarcastic. And you can see that in Texas and in Florida and in New York and in Pennsylvania and up in North Dakota where the oil sands are, but also in California, there, like the former Tosco chemical refinery and on the bay, there's a lot of pollution getting pumped out. So, and Kian, to answer your question, how do we get a list of the companies that are regressing? Send me a LinkedIn or an email, and we'll share what we know. Okay, so we've built a climate model. And so one of our team with a technical skill, who also went to the University of Chicago Harris School, Liana, built the climate model with our team, along with Ornindo, who is highly technical as well. And what we did was pull all the climate events of the past decades from FEMA and map those to 3,000 counties in the US. We then amplify those by the more than 511,000 toxic sites that exist in the US, and they exist everywhere, including in California. And then we divide by the resilience of each of these areas. And the resilience is there more forest or more farmland? Because forest absorbs climate events and farmland is susceptible to climate events. Is the construction newer or older? Because newer construction is more robust, then older construction is more sensitive. And even things like, what is the state of the climate action plan? What is rated in red on this are the geographies where there's at least climate risk and there's almost no resilience. This isn't purposely a political map, but it is the result on the resilience side of the lack of political support for resilience. This is only going to hurt themselves, just like this week's budget bill. This is self-inflicted chaos waiting to happen. So from an investor perspective, one, you want to be aware of what companies are exposed here. So Liana on our HIP team, for example, um, looked at the 235 Apple retail stores, and surprise, surprise, it's the ones in Florida and South Carolina and Texas that are more at risk. So companies need to evaluate where they're exposed. Logistics centers, retail centers, transport lines. But also, these geographies need to start taking climate action. And so, municipal bonds in these areas are at risk. So, one of the things we did was let's take a look at the municipal bonds, Moody's ratings, the credit ratings, which is supposed to be what's the risk of financial payback, and how do they relate to the climate ratings? And basically, from a statistical perspective, it's a near zero correlation, meaning the credit ratings on the right-hand side of these AAA bonds, some of them are in climate risky areas with no resilience, like City of Galveston. You have Lafayette, Louisiana. You have a Baptist Hospital in Florida. You have the aptly named Reagan Memorial Hospital in Texas, Oklahoma Medical Center. And then you have some lower rated bonds that are more resilient in Pennsylvania and Ohio and New York. Those climate ratings probably should be higher on the top for the greens, and the ones on the red should probably be lower. This is a inefficiency in the market today. When you look at green bonds, the good news is most of the green bonds today are in more climate resilient areas, but there are some that are in more climate risky areas. And so you just need to be careful if you're buying the City of Tampa, Florida water green bond, which is intended to help keep the water clean. Or you need to be careful about the American Muni Power green bond in Ohio because they're still burning a lot of coal, oil, and gas. So they are beginning to shift to more renewables, but that is the risk. Okay, so just a little side fun fact. You may know that Palm Beach County is the home of Mar-a-Lago, and that is one of the riskiest climate areas, being in Florida, being at a low altitude, being on the coast for sea level rise. But also, what most people don't know is most of the garbage in South Florida goes to waste facilities in Palm Beach County. And so, climate events have a higher risk of unleashing the waste, the methane, the pollution, the sometimes for utilities, the coal ash ponds into the water supply, into the air. So if you, when you get the deck, you can click on this leader and laggard. You can see the top three and the bottom three of counties over 250,000 people. So this is all, these are all things you can do for your portfolio. This is as of June 30th, Monday. This is the year to date and 1 year performance and inception to date performance since as early as 2009. And so these are strategies that have been around for more than 5 years to 15 years. And so you can see what I mentioned about the great place to work, returning 14% a year. And you can see that this year, global dividends for the half year to date is up 28%. And that's with this international diversification. John at the beginning asked about international funds. There's going to be more movement of capital internationally. And so it's not just the fundamentals of the companies you're investing in, but it's the geographic and political risk you're exposed to. Okay, so we have about 10 minutes left. So that's what you can do in your personal portfolio. Let's take a question. Maria asks, I've been banking with Wells Fargo since I was 18, and I really want to find a more ethical bank. Do you have any sustainability considerate banking suggestions that also have good return rates? Our local credit unions answer. Local credit unions are almost always a good answer because they are community focused. But I mentioned earlier on, Maria, there's a bank scaling up called Climate First Bank in Florida, Climate First Bank, and their checking pays 4% and their money market pays 5%, and it's FDIC insured, and they loan the money out to projects that are improving climate, or taking climate action or improving the environment. So check that out, Climate First Bank. But any community bank is generally a good idea, but always do your research. And then I mentioned a bank started in San Francisco called New Resource Bank is now Amalgamated Bank. They've been around for 100 years because they've worked with unions. So Amalgamated Bank is based in New York. And there is a group called the GABV.org, the Global Alliance for Banking on Values, GABV.org. And that lists banks not only in the US, half a dozen banks in the US, credit unions, but also in Canada and around the world. So GABV.org, Climate First Bank, Amalgamated Bank, credit unions, and then I'll also mention my C note, MYCNOTE. Those are all possible places um, for your banking. And then NE says if you go to mightydeposits.com, that's another bank loan locator, and it shows the loan mix. This is important too. Should we hit a recession, which is potentially coming soon, knowing the strength of the bank is important. Okay, so your 401k also shows your values. You can see Rosie here in the front row on the left. Rose ran for Congress in California's first district. She did not make it through because it's more conservative than what Rose was advocating for. Maybe that will change in the next cycle. And your 401k, your employer's 401k shows your values. Now, this is a touchy topic because every change in administration, from Bush to Obama to Trump to Biden to Trump, shifts the rules on 401ks. So, what is for bigger companies, they think about the risk of being sued. And 401ks can get sued. So, like Intel's 401k got sued because it put in private equity in the 401k and it didn't do well. Morgan Stanley's 401k got sued by its employees because they had high fee funds when they should have had fees that were more attractive. So when you talk at work about your 401k, know that think about it from their perspective. There's a liability perspective. Um, uh, Now, it is the case for the past almost 10 years that these numbers are almost the same every year, that people would like their investments to reflect their personal values, that it's important to make the world a better place, that companies who provide clean water and clean energy are better for my portfolio. And despite these numbers being over 50%, over 60%, over 70%, the movement has been slow on 401ks. It is practically easier for smaller companies. So if you work for a smaller company or you work for a progressive company, it may be easier, but it's still not that easy. However, if you want to go we're going to do a quick tutorial on how to do it. And so the traditional index funds, and here these are all Vanguard funds. They are typically they're frequently in a lineup because they're low fee. Now remember, low fee doesn't mean great performance, but it at least means low fee. They're not always gun free. If you have a small cap index in your portfolio, you likely own Struger, which produces AR-15s. You also own retailers who sell guns, and those could be automatic weapons too. And they're not always fossil free. So most index funds that are diversified are 8 to 10% into coal, oil, and gas. And you can look these up at fossil free funds, as we talked about earlier, and that gets updated monthly. However, a more sustainable 401k would have choices from Parnassus, Pax is now called Impax, Trillium. We produce 401k portfolios, fossil-free portfolios for small 401ks, usually in small to mid-sized companies. So these are all choices that you can look up afterwards and see maybe these are good for your 401k, your employer's 401k. And all of these are gunmaker free, and they're free of fossil fuel producers in oil, gold, coal, and gas, and fossil burning utilities. It's not easy to maintain this. It takes a lot of attention. The fund managers sometimes shift their holdings, and so paying attention to this is super important. So here's here's some free advice. Remember, it's free. You're not paying for it. So take it for, it's free worth. But this is the base portfolio that we use in a fossil-free portfolio. And earlier in the conversation, John asked about what can I do internationally? So this has been shifted in early 2025 to include the Hartford Global Impact Equities and the Morgan Stanley Europe Opportunity. Some version of these funds are available on Schwab and Fidelity and Vanguard, but not always. Sometimes you have to use different there's there's the same fund with different classes, and so sometimes you have to tweak that. And sometimes there's a fee. So Schwab, for example, charges $24 to trade. Forget which one it was. So if you're putting in $10,000, that might be okay, but if you're putting in $100, that's, you shouldn't do that. Um, so what you can see here is that all of these funds, as of the last evaluation date, have no coal, oil, gas producers and no fossil utilities. You can also see what we do is we collect all that greenhouse gas information and roll it up, and that the average holding of these funds is more efficient than the S&P 500, the global index, the emerging market index. So this far right column where you see 100 to 400, most of our holdings are lower, and the ones that are in the 150 or 200, those are more comparable to emerging market exposure. So generally they're less. And if you roll that all up, you can see that they're less. They're less for greenhouse gas emissions. They're less in fossil exposure. And where this is fundamentally strong is fossil companies are full of risk. It's like the cigarettes of our time. Remember, the cigarette companies got sued by the state attorneys general. They were found guilty. The fossil fuel companies, not under today's administration, but under a future administration, may face that as well. And fossil fuel companies are being divested, like in Scandinavia, for example. Okay, if you care about diversity, these funds also have women on the management team and people of color on the management team. And they can produce with more, if you tilt towards more equities, they can produce double-digit returns over time on average. And the more conservative ones are, upper single digit over time. And that all depends on what cycle you're investing in. Okay, so there's a 401k toolkit. I think Timothy is on the line. Green Retirement, his firm, Hip Investor, and the nonprofit As You Sow have produced this fossil-free toolkit. You can find that at Fossil Free Funds and at this link. Stoke was written about for its early move into becoming a fossil-free 401k and a gun-free 401k. They're very excited about this. So they're about 100 plus people now. The Fossil Free Fund site is at As You Sow. They also look at gender diversity, at deforestation, at guns and weapons. And so, Heidi, your question, what would be a good online resource to research sustainable ETFs? On your own, you can use this fossil free funds and see the others. HIP does have a website where we have a portal for companies and for bonds. And then if you work with us as an advisor, we can evaluate your portfolio, for example. Okay, and then Mira reports that Beneficial State Bank, which is another sustainable bank in the East Bay, has both individual and business products at Beneficial State Bank. Okay, final 2-minute wrap up here. So we showed you how you can invest your portfolio, including your IRA, Roth IRA, SEP IRA. We showed you how you can allocate in your employer's 401k. It takes work to get them to do it, but smart employers want to keep their employees happy. We talked about voting your shares of stock at the beginning and about engaging. So the last thing I want to end with is if your city or county or water district or municipality that you live in has a climate action plan, go find out about it, read about it. Their climate action plans try and facilitate more fossil-free energy, more resource-efficient buildings, more low-carbon transportation, how to make waste, eliminate landfill and use biodigesters for waste, how to have clean natural resources like urban forestry and wetlands protection, and how to have resilience programs. Taxes are not going to solve everything going forward. Developer fees are not going to solve everything going forward. And muni bonds are not going to solve everything. So these cities and counties will need more grant funding, more loans, more debt, private debt, more private equity, possibly, and public-private partnerships. And so on the HIP website, we have a whole catalog of this, of cities that have done this at least once. And so encourage you to engage your city or county on their climate action plan. And if you are of means to help fund some of that, even if you want to give a donation or a grant, your city may accept it. So I'm Paul Herman of HIP Investor. We covered a lot of ground. I'll answer the final question here from Tyler. Does impact investing normally just mean dealing with climate or environmental issues? No, it means also people and trust. My company and I are helping house people with developmental disabilities, and I wasn't sure if we're still in the impact space. Yes, you're in the impact space. If you're helping people, planet, or trust, you're in the impact space. There are many things under impact. If you know about the Sustainable Development Goals, the SDGs, those are 17 different forms of impact. There are more than that. So yes, Tyler, you're in the impact space. We appreciate you helping people of all abilities and excited that you're engaged in that way. All right, I'm Paul Herman. Feel free to email me at paul@hipinvestor. Feel free to connect with me on LinkedIn. We work with individuals like you, with advisors, with fund managers, as well as foundations like the Sierra Club, and 401ks. So, Jonathan, thank you for having me today. I'm so glad that Leo brought us together 15 years ago when we launched the HIP book at the San Francisco Public Library.
Thank you so much, Paul. This was a really great presentation. And yeah, despite all the or how grim the climate situation can feel, as you point out, there are practical things that we can do. And this was a great way to fight the idea that changing this is impossible. So thank you so much for this. I hope everyone that joined us today got a lot out of it. Just a little reminder, later this afternoon, I'll send out an email to everyone who registered. It'll have a link to the recording of this program, as well as a PDF of the slideshow, so you can get all these valuable links that Paul provided. I'm also going to include in that email, I already put it in the chat, but it's a link to a very brief evaluation survey that the library has. Please take a moment to fill it out. This is how we improve our programs and plan new ones. So if there's a topic you'd like to see us do a presentation on, let us know in that survey, and we'll do our best to find experts like Paul to come talk to us about it. So thanks again, Paul. It was great having you. And thank you, everyone, for joining us this afternoon. We hope to see you at a future event. Take care, everyone.